So when a correction hits, it's not unusual to see it spike to 28, to 30, to 40. But a lot of times these little corrections hit, it's a few days of some furious selling in this VIX can really explode higher. So this is our shock absorber. This is what we like to do. We want to come in and we want to buy a call option. For me, I don't mind buying. Preston, would you look at the 21 or the 22 call here?
When I buy, I like to buy closer to the money because I'm doing it in a spread. If it was just so people know that I do not like buying out the money options when I buy, but if it's in a spread, it's a completely different deal. So for me, I'd buy and I think they have 50-cent increments, but I'd buy the 1950 or the 20, just that's close enough.
There you go. Let's roll with that example. So if we buy the 20, if the VIX goes up, this call is going to explode in value. But we like to trade this in a spread. What that does, if we come in and we come up way up here out of the money and we sell a call, we're just putting a ceiling on this upside potential, right? So this call is going to make money if the VIX goes up. Market drops, VIX goes up, our 20 call is going to create a nice juicy profit for us. But to bring down some of our risk, to bring down some of our exposure, to not pay full price on this insurance policy, this portfolio insurance, we like to come in and sell a call option above it. Okay, Preston, so what you like to do, a $5, $8 spread, something in that ballpark usually, right?
My normal one's a 5.
Perfect. Sorry, I keep trying to fly, thinking of the time here. We're selling a $25 call. So think of it this way. We just put a ceiling on the call that we bought. Okay, this can make money. If the VIX blows up to 30 or 40, we've just capped our upside. But the flip side of this, Preston, if you have an option chain, maybe you go grab me some quotes real quick on that 20 call and the $25 call. And we usually like to go a couple months out of the money. So I might look at the April expiration here. The April expiration. So something around that third Friday, the 17th, right? So we're paying money. We're buying the 20 call. We're selling this 25 call. It puts a ceiling on the trade, but then we bring in a whole bunch of cash in it. It brings down our cost. We're making our insurance much, much less expensive, much less risk, because if the market does keep up trending, this is going to lose money. Okay? So we want to bring down our risk. We want to bring down our exposure while still having a really nice upside potential that will just take some of the shock out of the positions if the market decides to really flip and drop.
Absolutely. I got the numbers for you, Mike. April 20 call on the VIX index, $3.20.
Perfect. And then the 25s?
The 25, $1.95.
$1.95. Let's make my math easy. We're just going to say $2. So this is going to cost us about $1.20. So per contract, that's $120. $120 that we're spending, and we've got this $5 spread, so we stand to make $5 or $500 minus our cost. So our max profit on this trade right here, and if you look at it tomorrow, the numbers are going to change, but our max profit is about $380.